Well, thanks for tuning in to the Mutual Fund Show. The question mark that is on the minds of everybody is, what if the markets, after scaling Mount 11,000, come off? What do they do with their mutual fund investments? But I would guess the answer is don't do anything. But then there are a lot of people who say that we have investments in the mid cap and the small cap end of the market, and those seem to be overvalued. Certainly, if you look at what the consensus trailing P multiples are, they do look overvalued. I've used the Bloomberg terminal out here to just draw out the kind of valuations that the mid cap and the small cap indices would be trading at. Trailing P, mind you, compared to the 5-year average P. Yes, these look very expensive. You got to keep in mind though, the markets are a lot more broader than what they are right now, and almost every expert that we speak to manages to say that even if the benchmark indices might be expensive, there are not one, not two, but enough and more investing opportunities that they are finding even right now. And mind you, a small pullback might not be catastrophic, it might actually be healthy. So how should you, as a mutual fund investor who is invested in mid-cap, small-cap, multi-cap, micro-cap funds, or is wanting to invest because he believes that that's where the real growth story of India is, approach that investing at the current juncture? I think it's a very interesting topic, something that I'm looking forward to over the next 20-25 minutes. And our first guest in the show, very special guest, Vishal Kapoor, CEO of IDFC Asset Management Company. Vishal, thank you so much for joining in today.
My pleasure.
What would your sense be, Vishal? Because this is a common question across the minds of not just many investors, but a lot of people in my office as well. They ask me that we are being recommended, or we keep on seeing how multi-cap funds and micro-cap funds and small-cap funds have performed, but we are scared of putting in money right now.
So clearly, I think two things I'd want to bring out. One is investing, looking at historic returns is never a great idea. You have to be looking ahead. And the second is around allocation. I think too much of a good thing is not a great idea. You've got to be able to spread it out. So if you do have a portfolio which is very, very concentrated into small and mid alone, then it's a good time to relook at it and say, why am I missing out on allocations across a few other sectors, industries, etc., whatever the case may be. But clearly, if you're looking at investing because the top performing fund in mid caps or small caps returned 60% odd in the last 1 year, and you expect that going forward, then that's not, I guess, going to be the case.
Okay, so that is part one. So how does an average investor who is trying to gauge whether or not he or she should, in the first place, invest in mutual funds? We've discussed this enough and we've passed on this message enough that it's about time, if you haven't done already, to start investing. But take the next leap. Let's say there are a set of investors who have some investment in balanced funds because they started off with balanced funds or equity savings funds. Then they moved on to pure play equity funds and started off with large cap funds. Now, for the last year and a half or that, they've been seasoned, in a manner of speaking, mutual fund investors, and they are wanting to see if they should test waters with the mid cap and the small cap and the micro cap funds. Is the timing a good idea, or even in this space you would say don't try and time the market?
I think if the investor's horizon is long term, I don't think you should shy away even now. Clearly the valuations are a bit rich, but keep in mind, as we all know, we are buying companies, we're not buying the index in most of the actively managed funds. And if you can find companies which are generating good earnings growth, then why not, I would question. So it is still feasible for you to have a fund which can find some multi-baggers of the future. And provided you are willing to ride out the cycle, generate good long-term returns. But the key is long-term, and the key is also allocation. If this is the only thing in your portfolio and you are going to get scared over 1 or 2 years, then it's not a good idea. But if it's a part of a portfolio and you're willing to stick it out, then I think it's still a very good strategy.
Okay, I think the question also comes about, Vishal, is because of those numbers that I showed. And yes, I know looking at trailing numbers is not a good idea, but I just showed them for depiction. The actual numbers would be maybe a bit lower, right, but still at a substantial premium. I believe the micro caps and the small caps would at a premium to the large caps as well. Forget the 5-year out of 10-year averages too. So is this time therefore prudent to maybe not look at investing in mid caps and small caps even from a long-term perspective, and just tactically waiting for a pullback which inevitably comes once in 2 years or thereabouts. I mean, 2017 is the year of historically low volatility and almost no pullbacks. At some point of time in 2018, we probably get a pullback, right?
So I think, while it's always tempting to predict yes, wait for a pullback, I think the reality is none of us are able to time it. And I think I come across investors, advisors, etc., who've been waiting for the pullback for all of last year, actually calendar 2017. And look what happened. You lost out on almost 30, 40, 50, 60% returns, depending on which fund or which sector you were in. So I think timing is really, again, going to be a bad idea. One interesting thing I'd like to share with you is a study we did on the last 10 years. And what do we think is actually driving the price behavior that we are seeing?
Across the market.
Across the market. And I think we all often, come to the conclusion that this is liquidity-led and this is trading-led, and there are sections of the market which have more demand than supply, and that is what is driving, 49.6x P's, etc., etc. The reality in our study was that if you looked at any company across sectors, large cap, mid cap, small, and micro, which gave reasonable returns, 10-year compounded return of 17% or above, which is 5x in 10 years, 17 times, right? 17 CAGR. 70 to 90% of the price behavior was explained by earnings growth. So we still go back to the point that in the medium to long term, you have to continue to focus on earnings growth and nothing else, because that's actually leading 70 to 90% of the price behavior that you eventually see. Of course, in the short term, you'll have technical factors and all of that, but don't take your eye off the earnings equation.
Okay, so pray tell me, and just wanting to understand from you, I think one refrain that I've heard in the last 6 odd months is that unlike the previous times when the price and the earnings both were at elevated levels, and then there was going to be maybe a bit of a pullback in earnings. This time around, while the prices have moved up, earnings catch up is yet to happen. Or even if the P multiple is looking expensive, earnings have to come back. If the IMF forecasts are to be believed, we are in a state of good growth for calendar year 18 and 19.
Right.
So do you believe earnings growth will take care of these worries even at the broader end of the spectrum, not just the large caps?
I think that's certainly what the market seems to be pricing in. If we look at earnings growth, and again, similar study, now let's look at since the last peak of 2008, so broadly the last 10 years. I think the theme that we note is the following, that since the last peak, so if you look at 2008 onwards to now, if you look at the market in broadly two halves, the first half being what we call broadly the stable sectors. So these are sectors which are agnostic to market cap sort of or investment cycles. So these are your consumer, FMCGs, IT, telecom, etc. You have the other half of the market, which is the classic cyclicals, which are your banks, which are obviously lending, capacity-led, energy, utilities, engineering, construction, etc. The stable part of the basket has actually been growing at about 15 to 16%. So very healthy growth right through. This is earnings growth. This is not price movement, earnings growth. It's the cyclicals which has actually dragged overall earnings down. So cyclicals have actually degrown by 1 to 2%, 1.2% actually over the last 10 years. So the average that we're looking at is 4 to 5%. Now obviously if you have EPS at only 4 to 5% and prices run up, it's leading to a very, very high PE. But the market's essentially pricing in a rebound in the cyclicals. So what we think will happen over the next 3 years is that as cyclicals now rebound, because this is just part of the capex cycle, you will have very high earnings growth in the cyclicals, probably led by banks, which will not have, the provisions already done, so you will not have as much provisioning going forward. Also led by all the infra spending that is going on, led by disposable income going up, so therefore consumption. So these are, few areas where we think there'll be a spurt in earnings. And therefore, over the next 3 years, the PE should normalize a bit. That certainly seems to be the hypothesis the market is based on today.
Okay. Now, there are a few skeptics, if you will, who mention that the problem of liquidity that hurts any large portfolio investor, private portfolio investor, when investing in mid caps and small caps, and certain, I'm not saying all of them are, we obviously know all of them are not illiquid, but certain mid caps and small caps, is a problem that could hurt mid cap and small cap funds as well. And because investor behavior isn't tested this time around with a down cycle which has lasted for a while, if that were to come about for whatever reason, and if redemptions took place on a larger scale, then large mid-cap, small-cap funds might have issues in even making the payment on time to investors, even if the investments have been redeemed. Can you shed some light here, if you think that that is even plausible in the first place?
Frankly, it's a nice problem we'd like to have. Unfortunately, we don't have that problem as yet. So our mid and small cap fund is very modest in terms of size. So we don't see an issue at all in that fund. Secondly, I think we do see investor behavior getting more and more mature with every cycle.
Okay.
And I'd certainly hope that that is the case even now. Now, that's 2 or 3 factors driving it. One is we've seen growing number of investors, and the longer they stay, the more maturity, the more experience that they gather. So if you've gone through previous cycles, then you know that you just have to ride out the cycle. The second is that the advisory community, the distribution community has grown significantly over the last 3 years. This is just the number of active advisors in the industry. So we'd hope that a lot of investors have someone to talk to during times of volatility, which has been missing over the last year. But as volatility returns, we are hoping that your investors will call their advisors or their distributors and take the guidance, because that's the time that we'll really see what transpires this time. The third is a large part of the growth in the industry is really SIP led. And one certainly hopes that that is going to be much longer and not as volatile in terms of flows. So all put, I don't think we should expect too much redemptions or volatility of that type. There's also a belief that there may be more of a time correction rather than deep price corrections in many ways. Because keep in mind, for every correction that sort of began over the last year and a half, we've always seen a lot of buying come in very early on into any correction. So there's still a fair amount of liquidity, one would believe, that's available for people to deploy. So if you look at time correction, then really any major upheaval in AUMs should not really be something that we could predict.
Yeah, I believe that is one very pertinent point that I think Vishal makes, that the last year at least we've seen evidence of this, that any large dip that has come in has been bought into, and investors, after a really long time, it's heartening to see that investors have not been into this mode of buying high and selling low. They've continued with the buying behavior even when the markets have shown that 2, 3, 4% kind of a dip, and hopefully, as he says, this continues. So let's talk about a couple of offerings that are there from your stable as well, just to make viewers understand about what these are. So the IDFC equity fund, I think there you're relatively low on the small cap allocation, only about 20% if I'm not wrong to small caps. What's the nature of this fund, and do you exhaust this small cap limit? Because let's face it, the gains, while large caps have gained quite a bit, the gains in the mid cap and the small cap end have been pretty robust as well.
So this is a fund that we like because one, it's been recently restructured. We restructured it just last year in Q1 last year, and we, I think, brought out a very innovative strategy, proven across many market cycles and many tests that we've run on it. So this is what we call a classic barbell strategy. Okay. It's a large cap fund. So 80% of its allocation goes into the traditional large caps. So you get the stability and the relative comfort of large caps because the bulk of your money is over there. Now the challenge with large caps that I think we often come across in the industry is that the ability of alpha on a consistent basis gets challenged over a cycle. Now that's where a 20% allocation to small cap comes in. So you get a good combination of the bulk of your money being in stable large caps, but you also have the potential alpha of small caps, not mid, but small, giving you the potential upside that a small cap does. Now, risk management is key because at the end of the day, the customer is buying a large cap. You don't want too much volatility in these products, which we manage very innovatively in this fund by capping the investment amount in small caps at 1% of the portfolio. So you're going to have at least 20 such names in the portfolio in small caps.
Okay.
Gives you diversification, it gives you a lot of width in these potential winners. We will cap it at 2%, so it will not become overweight. So it doesn't, again, give you a lot of volatility. Keep in mind, 80% is still in large caps.
Yes.
So it's a large cap offering, which we think is very innovatively produced. It's been restructured recently. Early results are very encouraging. So that's something that we think, again, going back to the theme that if you want to switch out of mid caps and small cap because you're overexposed there, also because your own allocations have now maybe doubled from where you started and you want to maybe go back to the comfort of large caps. Again, going back to our theme that if cyclicals will do well, a lot of those cyclical names are actually sitting in the large caps. You know, the commodities, the energy companies, the engineering, the big banks, etc. If this is where earnings growth will come in the future. Go back to the theme that, you know, on a P basis, actually mid caps are ahead of large cap, which is not the long-term trend. Long-term trends are mid caps normally are a discount to large caps, and that does position you to say that, look, maybe you should have a bit more of large caps, but you also need alpha in an actively managed fund.
Sure.
So that's where we think this fund is very innovatively positioned.
Okay, just a couple of quick questions before we wrap up this discussion with you. One, has the recent restructuring happened because of the change in norms, or do the change in norms apply and you will have to change this allocation even further?
So we restructured this in April last year.
Okay, so this is not due to the change of SEBI.
Yeah, but after the SEBI norms, it doesn't change. So it remains as
you don't need to change.
We don't need to change because the 80% rule that SEBI has is still getting complied with.
Okay.
So that's one that we think we like.
Okay.
As an alternate strategy, and this is just for investors who may not want too much equity exposure, maybe you're new to equity and you don't want to really get into something and then have to move between large cap, mid cap, small cap. One more fund, if I can suggest, is our dynamic equity fund. Now that's a fund that we think we like because it, in a sense, has advice built in. When I say advice built in, most advisors will tell you that if P's are very high, then go underweight on equity. And if P's are very low, go overweight on equity. Now, while advisors, and having been an advisor myself in the past, while we'll advise this, there are few takers. And often, people will say, no, in a bull market, I'm just buying irrespective of your advice. In a bear market, I'm not buying irrespective of your advice. And the dynamic equity strategy actually takes care of that because the fund is doing it for you. So if the market is really cheap, this fund can go 100% into equities.
Sure.
If the market is really expensive, it will cut down equity exposure to 30%, and still give you the tax advantage of an equity fund. Within the equity allocation, again, we can change the equity, the large cap to mid cap to small cap exposures. So if the markets are very expensive and you want to be conservatively positioned, we increase the large cap exposure.
Sure.
And vice versa. If the markets are really cheap and you want to give the full alpha to the fund, then we increase the small and mid cap exposure. So it's a built-in product for early investors or investors who don't want to be very active with their equity allocation. You want a fill it, shut it, forget it product, then this is it.
Great. Okay. Vishal, we do hope that investors don't face the choice of redeeming funds from their mid cap and small cap or micro cap or multi cap funds, and hope that the party doesn't spoil so badly. Even if it were to be correcting, it's a healthy correction. One certainly hopes for that. But thank you so much for taking the time out today and giving us your thoughts on the mutual fund.
Thank you for having me.
Of course, pleasure having you. Okay, now while we are talking about hopefully no dangers coming in from mid-cap, small-cap investments, I think Joshi has put together a fairly interesting analysis of funds which probably haven't even done well, even though they are in the micro-cap and the multi-cap and the mid-cap and the small-cap variety. They haven't quite gone out and set the stage on fire. In fact, have underperformed the index despite having fairly large AUMs. Hear out what he has to say.
So Neeraj, in the last 3 years, the Nifty mid-cap index, point-to-point return, of course, has given you about 64-65%. But that does not mean that all funds which are in the mid-cap category have gone up more than that, or at least as much as that. So there are some funds which have underperformed the index itself. Here's a list of some of them. So the criteria that I selected was that the total asset should be at least 1,000 crores in the fund. Now, if you look at the Axis mid-cap fund, that has given given you a return of just over 36% versus the 64% that I was telling you about the mid-cap fund. So is the case with DHFL Pramerica, 37% return for that as well, and followed by SBI Magnum Global Fund. Now remember that this has underperformed despite the fact that it has 37,000 crores in total assets that they manage, and the most focused mid-cap 30 fund that has given you about 49%, and this too has total assets in excess of 15,000 crores. So you might be one of those who would have invested into these particular funds and still underperform the market. And while looking at the screen, the Nifty Mid Cap Index has still gone up about 64%, and yet the money has not been made at your end.
Well, thanks a lot for that, Jayesh. Very interesting that this category, and of course all categories do find underperformers too, but this category too has that. Let's talk about that and more with Amol. Joshi joins us a number of times on this mutual fund show. And Amol, great having you again on the mutual fund show.
Always a pleasure to be here, Neeraj, with
Thanks so much
on the show.
Thank you so much, Amol. Now, Amol, we just the theme today is talk about whether or not it's prudent to go out and invest into mid-cap and small-cap funds. Right. Now, the reason people would probably go into a mid-cap and small-cap funds would be to get higher returns.
Sure, that's true.
Now, there are two impediments, right? One is if you ended up investing in a fund that Jayesh just spoke about and have been underperforming the benchmark index itself, that is one. Two, if you're investing at levels like these wherein the mid caps and the small caps are at a significant premium, sure, and there is a perceived risk of a correction coming in.
Sure.
So how does an average mutual fund investor invest? What are you telling your clients to do?
Okay, so first and foremost, you are on dot when you say that people mostly choose mid-cap or small-cap funds when they are looking for that excess return over and above what benchmark is capable of deliver. Anybody who wants to enter because of this reason, that person is best served with two strategies. One is invest when you have reasonable valuations. Clearly, we are not today is not the time when we say that. Second strategy would always remain that take a staggered or a measured exposure. You have a very good tool in mutual funds. It's called Systematic Transfer Plan, STP. So you want to invest 5 lakh rupees. You can have, let's say, an STP of 80,000 to 1 lakh rupees per month, or let's say 20 to 25,000 rupees per week. And you can take that 5 lakh rupee exposure to a mid cap or small cap scheme over next 6 months. That is the strategy that you can use when you are not totally comfortable with valuations.
Okay, what about somebody who doesn't have that exposure, wants to start off, say, let's say an SIP? Right. Yeah. Is it, I know the argument would be, or the common argument would be that if you have a long-term vision in mind, it doesn't matter. But what if somebody wants to invest with a 3-year perspective? The question mark is it prudent to choose a mid-cap or a micro-cap fund currently, or would it be prudent to choose, arguably, a slightly more liquid and safer fund? And then, if at all, and when a correction happens, go out it. I mean, would you tell your clients to time the market in that way?
Okay, my answer slightly differs over here than the first point. First point was about lump sum. Today, now we are talking about SIPs. SIPs would do the very same thing, what you mentioned just now, that you could probably start with a safer fund. I don't know, maybe balance fund, maybe equity savings fund. One of our previous shows, we discussed that. But if the market were to go down, let's say for 6 months, market has a lean patch, let's say from July to December. During that patch, your 6 SIP installments that go will fetch a much better averaging to you, which is what SIP does. So I would say that if you are entering today with a 3-year horizon, I'm not very sure, but you can. Sure, in terms of you will be able to see the kind of returns that they have generated. Last 5-year returns for mid-cap scheme, average mid-cap scheme is about 25%, average small-cap scheme has delivered 30%. So you could probably tone down your expectations a bit. 5 years back, you know what levels market were at, what valuation levels were. We are currently obviously not there. But if you have a 3 to 5 years kind of horizon, via SIPs, mid-cap and small-cap, you could still enter. As always, it remains it goes without saying that you would always do it with asset allocation in mind. You would, within equity also, you would always pay attention to large cap, multi-cap scheme exposure as well. So mid-cap need not be your only strategy for investments. It could be 1 out of 2 schemes, 1 out of 4 schemes, other 2-3 schemes being at other levels of market capitalization, maybe multi-cap, maybe a large cap too.
Now, I don't know if you've studied the funds that Jayesh brought out, but could there be specific reasons to each of those why they have underperformed, or would it be a bad apple or two in the entire portfolio?
Right. So one of the funds specifically I know about why it hasn't done so very well is because first and foremost, see, it can happen only when your stock calls go wrong, right? So something that you bet upon heavily did not work out. And I know one of the sectors, one of the funds mentioned over there was low on PSU banks or corporate banks, so to speak. And you know, few weeks back, after the announcement of bank recapitalization program, many PSU banks went up between 30 to 50% in a trading session, one trading session. So obviously that remains one of the key reasons when you are when the sector that you are not present in does very well, so you will not do as good as what benchmark or other scheme category average does.
Yeah, fair call. Okay, now what is it that you would be advising a new client who is coming and saying that I want to start off, say, 2 SIPs or 3 SIPs? What does he or she do? Do you advise him to segregate into a large cap, a multi-cap, and a balanced or an equity savings fund? What's the current advice that you're giving out people?
Right. So current advice for, let's say, a 2 SIP or 3 SIP kind of breakup, if I were to suggest, my choices will be in the following order. One is I would choose a large cap fund for a medium to long term horizon. I would choose multi-cap fund. So it is, if I want an outperformance, slightly higher kind of return from mid cap or small cap, it is not necessary that I go whole hog into the mid cap or small cap fund. You have multi-cap category of funds where there will be exposure to large cap, obviously a large part, but some component around 30 to 50% will be towards mid cap and small cap as well. So my second choice of fund will be multi-cap, and third choice of fund, of course, will be a balanced fund. Balanced fund, again, previous shows we have discussed balanced funds or equity saving funds or dynamic asset allocation funds. They remain a good choice for somebody who is starting out the investments. But these funds, now the time is there, especially the kind of valuations what we have today. This time can be called as balanced fund, such a versatile fund that it will find a place in every investor's portfolio. So
what are these? I mean, I have some names, but what is it that you are recommending to your client?
If I were to choose a large cap fund going in the same order, I would probably choose Aditya Birla Sun Life Frontline Equity. It is one of the decent funds in large cap space. Over a 13-year history, it has never underperformed its benchmark. So you know clearly that it is doing very well. My second choice was multi-cap fund, one of the funds that we have discussed many number of times. Motilal Oswal multi-cap 35 still remains a good bet. The third fund in balance category, it's a toss-up between ICICI Prudential Balanced Advantage, again a fund that we are familiar with, we have discussed it, and HDFC Balanced. So quickly, Balanced Advantage remains a dynamic asset allocation fund. Equity component can range between 30% to 80% when the market is supposed to be expensive. As per the valuation metrics that fund follows, the equity exposure will be only 30%. And when markets are inexpensive, cheaper, the equity component can go as high as 80%. So that's very briefly about Balanced Advantage. HDFC Balance remains a strong balance fund with a consistent allocation to equities 65% and upwards, 65-68% kind of. So these are my 3 or 4 choice of funds for 3 SIPs, what we just spoke of.
Okay, last question, Amol.
Sure.
Anything in the small cap fund category or small and micro cap fund category that you are comfortable recommending, or you've studied in the past and you've been impressed with the performance, may not necessarily be an investment right now?
Right. So Reliance Small Cap is certainly one such fund which has shown a lot of spark during the 2014 rally. What we saw after the new dispensation took over the central central government, that fund has been doing very well. It can be looked at for investing today as well. However, I would say that your horizon should be significantly more than 3 years. So you should look at it with a 5-year, 7-year kind of horizon. You should always be mindful that small cap fund will essentially invest in companies that are small. So any company that is small will not have, the going will not be easy. The big boys are not going to just simply give them the top spot. So it will take some time and be in that journey with these small cap companies, and you will be likely rewarded at the end of the tenure.
Great. Okay, Amol, good having you. Thank you so much for taking the time out and joining us on the Mutual Fund Show as always.
Pleasure, Neeraj. Thank you.
And viewers, thanks so much for tuning in to this week's Mutual Fund Show.